stop. Before you make any decision about buying, selling, or investing in real estate right now, you need to watch this video. Because right now, there are two completely opposite camps of people. One group is screaming that a massive housing crash is coming in 2026. The other group says prices will keep climbing and there is no crash in sight. Both groups cannot be right. And today, we are going to look at the actual numbers, the real data, and figure out what is actually going to happen to the U.S. housing market in 2026. I'm going to give you 3 specific scenarios, and I'm going to tell you exactly what to do in each one. Stay with me. Let's start with where we are right now. As of early 2026, the median home price in the United States sits at approximately $420,000. That is more than double what it was just 10 years ago. In 2015, the median home price was around $220,000. Mortgage rates, and this is the number that is crushing buyers, are hovering between 6.5% and 7%. For context, back in 2021, you could lock in a 30-year fixed mortgage at under 3%. That is a dramatic shift. Here is what that means in real dollars. On a $400,000 home with a 20% down payment, your monthly mortgage payment in 2021 was roughly $1,350. At today's rates, that same home costs you approximately $2,100 per month. That is $750 more every single month. That is $9,000 more per year, just from the rate change. This is the affordability crisis that is quietly strangling the market right now. Now here is the twist, and this is what most people completely miss. You would expect that with affordability this bad, demand would collapse and prices would drop. That is basic economics. But here is why it is not happening. Inventory is at historic lows. Right now, active listings across the U.S. are approximately 40% below the pre-pandemic levels of 2019. There are simply not enough homes for sale. And the reason is something called the lock-in effect. Millions of homeowners locked in mortgages at 2.5%, 3%, even 3.5% during 2020 and 2021. If they sell, they have to buy a new home at today's 6.5% to 7% rates. That is a financial penalty most people are not willing to pay. So they are staying put. They are not listing their homes. The result: you have a market where buyers can barely afford to buy, but sellers refuse to sell. And that supply crunch is the single biggest reason prices have not crashed. Oh, let's Steelman the crash argument. What would actually have to happen for a crash to occur? Number 1, unemployment would have to spike. In 2008, the crash was triggered by mass job losses that forced homeowners into foreclosure. Right now, unemployment is approximately 4.1%. That is not crash territory. But if the economy softens sharply in 2026, if layoffs accelerate, particularly in tech, finance, and real estate, forced selling could flood the market. Number 2, a wave of adjustable-rate mortgage resets. A significant number of ARMs, adjustable-rate mortgages, that were issued between 2019 and 2022 are scheduled to reset in 2025 and 2026. When those rates adjust upward, some borrowers will face payment shock. The question is how many, and whether they can absorb it. Number 3, new construction outpacing demand. Builders have been ramping up. If supply floods the market at the exact moment buyer demand continues to weaken, price pressure increases. A 15% to 20% price correction is possible in the most vulnerable markets, but a nationwide crash of 30% or more, the data does not currently support that. Pattern interrupt. Let's get historical for 1 second. The 2008 crash was not just a housing crash. It was a credit crisis. Banks had issued trillions of dollars in subprime mortgages, loans given to people with no income verification, no assets, and no real ability to repay. That is fundamentally different from today. Today's mortgage lending standards are significantly stricter. The majority of loans on the books are 30-year fixed-rate mortgages held by borrowers who qualified under tight underwriting standards. The structural risk is simply not the same. That does not mean prices cannot fall. It means a 2008-style collapse is not the base case. Here are your 3 scenarios for 2026. Scenario 1. Soft landing. The Fed gradually cuts rates. Mortgage rates drift down to the 5.5% to 6% range. inventory slowly rises, and prices stay flat or increase modestly, maybe 2% to 4% nationally. This is currently the most probable scenario. Scenario 2. Regional correction. Markets that saw the most extreme price appreciation, parts of Florida, Texas, Arizona, and the Pacific Northwest, see price drops of 10% to 20%. National averages hold roughly flat. Some buyers get good opportunities. Long-term investors stay the course. Scenario 3. Broader recession-driven crash. A recession hits in 2026. Unemployment rises above 6%. Forced selling increases. Prices drop 20% to 30% in overheated markets, 10% to 15% nationally. This scenario requires a significant negative economic shock, possible, but not the base case today. So what does this mean for you? If you are a buyer, do not wait for a crash that may never come. Focus on what you can afford today. Look at markets where inventory is rising. Negotiate hard. Get a fixed-rate mortgage and stop trying to time the market perfectly. If you are a seller, your window of pricing power may be narrowing. If you have been on the fence, 2026 is a critical decision point. Overpriced listings are sitting. Price right and move. If you are an investor, focus on cash flow, not appreciation. In this rate environment, the math on speculative flips is brutal. Long-term rental properties in supply-constrained markets remain the strongest play. The real truth about the U.S. housing market in 2026? It is not a simple crash or no crash story. It is a market under enormous pressure from three directions: high rates, low supply, and stretched affordability, and the outcome will depend heavily on what happens to the economy in the next 12 months. Watch the jobs numbers, watch the federal, and watch your local inventory data, because real estate is always, ultimately, local. If this video gave you clarity, hit subscribe. See you there.